The views in this media are expressed by Michael Maddle and other participants and are not reflective of the Sovereign Wealth Fund Institute, SWFI.
And now, the world's most informative show on institutional investors. Follow the money, home of sovereign funds, pensions, and other long-term capital. And here he is, Michael Madwell.
Welcome to Follow the Money, the show on institutional investors. I am here with my co-host, Rachel Pether. She's out in the Gulf reporting, giving us insight and news with what asset owners are doing in the region, a very hot region, a very fun region. Rachel, how are things this late afternoon night for you?
It's been both those things recently, actually, hot and fun. We're starting to turn here at the moment, which means I'm very much looking forward to escaping in a few weeks to Singapore to see you. So, yep, it's all going well.
Singapore will be fun. We're very excited about it. We have a very diverse group of delegates coming. I just saw the attendee list and I was surprised. Again, we pretty much have attendees coming from around 5 different continents in one location. And it's going to be at the Capella. I believe we have about 2 weeks left for sign-up. So if you haven't gotten to sign up yet, go to ifsummitasia.com. Seating is limited. We really want to keep it nice and niche and close. And if you want to learn more about the event, we have a slideshow off ifsummit.com. You can take a look at some of those pictures there and kind of see the quality of the speakers and delegates through those photos. We have some news in the Sovereign Wealth Fund world. Have a story about Mubadala revealing their 2016 results just before their merger with IPIC, another Abu Dhabi state-owned vehicle. And the results look pretty good for Mubadala. And maybe Rachel, maybe you can give us some insight on how those results will play into the merger coming up in May.
Sure. So as you rightly pointed out in the story you guys ran, it's probably the last time that we're going to be referring to Mubadala Development Company because the merger is due to happen before the next semi-annual results will be published. So if we look back on the full year for 2016, Mubadala had profits of almost $1 billion, about $900 million, and revenues of about $8.6 billion. And the key contributing drivers to this were the semiconductor, aerospace, and healthcare sectors. Now, this was interesting to me because if you look at the contributors to revenue by platform, we actually had technology and industry contributing almost 70%, so 68.2%. Energy was only 13.5%, and aerospace and engineering were 11.2%. So obviously the percentage contribution of energy was affected by the lower oil price. But, you know, there are always a lot of stories in the financial press about how the low oil price is putting the brakes on Middle Eastern governments. And while this is true to a certain extent, you do have to realize that a lot of these Gulf states, particularly Abu Dhabi, which isn't a country, but one of the Emirates of the UAE, Kuwait and Qatar, they've actually been focusing on diversification for a while now. So to see that, you know, only 13.5% was driven by energy just shows how those diversification efforts have really been playing out. What I also thought was interesting, just from my point of view, was they had a major capital raise last year and they issued a $500 million 7-year bond with a coupon of 2.75%. And it took me back to the GMTN program that I worked on with them in 2009, where the 10-year bond was priced at like 7.625%. So you've really seen a shift, you know, both in the interest.
There are some low interest rates.
Yeah, totally. And, you know, dropping by almost 5%, so down to a third of what it was before. I mean, the risk profile of Mubadala hasn't changed that much because it does have an implicit guarantee from the government of Abu Dhabi. So, yeah, we've really seen a changed interest rate environment since 2009. So I think Mubadala looks like it's in pretty good shape for the IPIC merger.
Yeah, and taking a deeper look into it, it seems that they've able to develop a larger investor base for those bonds, being able to command a much lower interest rate in this type of environment. And it will be interesting to see how they integrate all the oil and gas assets, because whether it's upstream or downstream, will they be selling off, you know, or will they be trying to limit how much exposure they have in that sector? And very fascinating to see how aerospace contributed to those returns and how that sector is going to be a much larger player, I think, in the region, because we're seeing other countries and wealth funds within the Gulf trying to get into aerospace, and it's a very tough area because it requires a lot of expertise, and you only need to form those joint ventures with some of the larger entrants that are already in the game. One story that I want to bring up is data centers. We've seen the PSP Investments go in and partner with another firm to acquire a data center company that was backed by Silver Lake Partners, which is a private equity firm. And we're seeing a lot of wealth funds, more so though pensions, backing data centers, viewing it as opportunistic real estate. Some pensions view it as infrastructure to fulfill their unfilled commitments. It just kind of plays in line with the e-commerce, the growth of big data, the growth of more data centers. And a few weeks ago, there was a large outage with Amazon, and that pretty much affected about 25%. That number could be off of the websites, and they were down. And so the need for more data centers, which operates sort of like a real estate operating company, is a very telling story. And it kind of fits with the story of student housing and how a lot of wealth funds and pensions are gobbling up those. I mean, the CPPIB and GIC, they have an arrangement with Scion Group, and they just, I think, spent about 1.3 or 1.6 billion buying just a huge portfolio of student housing arrangements across the United States from a lot of the major universities. So it's interesting how they've gone from core real estate, apartments, and now they're looking at student housing and data centers, kind of going along the risk spectrum here, because there's a lot more factors at play when you're looking at data centers and student housing.
Absolutely, and I think that really plays into the long-term view, and they're looking at the macro trends and technology and education. Well, education's a kind of a primary need, and the technology sector is really one that's growing. So it's quite a nice kind of, sits at the intersection there between real estate and also has that infrastructure-like quality, doesn't it? Because you get the kind of steady returns from it, but in some cases you also have the typical real estate kind of capital appreciation from the land value as well. So it ticks a lot of boxes. I think it's great seeing the wealth funds being a bit more creative and not just investing in.
Kind of looking at this PSP Investments deal, one of the assets that they own is in Quincy, Washington, which is, we're in Washington ourselves, the research side, and it's just across the Cascade Mountain Range, and it's on the drier side of Washington. But what's interesting about Quincy, Washington, which is a very small farm town, it has access to hydroelectric power, which is really affordable, and it's renewable. So we're seeing actually not just the data center by the company that they bought out, but we're seeing Microsoft's already there. You're seeing Yahoo there. But there is a little tension there. I was reading some old articles in the New York Times, and I guess that the data centers were driving up the energy costs for the farmers. So it's really hard to have a business and not affect the ecosystem no matter what you do. I mean, we can talk about wind energy, but then when you put up a wind turbine, you have to watch out for the birds. Same thing for solar panels, because sometimes the panels can blind out the birds too. So everything has a cause and effect, and you have to weigh the pros and cons. But at the same time, though, from a business standpoint, I think having data centers, the low energy costs, is probably beneficial and probably brings in more profit for the owners. And if I want to look at it at a different angle, it's probably bringing a few high-paying jobs into the region as well.
I mean, a lot of the tech, there are quite a few big tech companies in Seattle now, and that seems to be attracting more and more talent and companies.
The Seattle region is prime with tech. I believe it's the little brother of San Francisco and the Silicon Valley, but we just have Amazon right now, and the stock just keeps on going up, and it appears that Jeff Bezos might be the richest man in the world. And then you also have all the companies that support Amazon in the region. You also have Microsoft, another giant that's been around for quite some time. So it's sort of the Microsoft Amazon ecosystem that's kind of driving that. And then there's a really healthy biotech sector within Seattle. So you have a lot of life science firms. One of them is actually Juno Therapeutics, which is a company that's trying to create some sort of these cancer killers, trying to it's a new way of fighting cancer, and they're based out of Seattle. And by the way, the Alaska Permanent Fund is a major investor. They were a major early investor in the pharmaceutical company. It was actually one of their first major direct investments.
And what happened, I remember a few weeks ago, that when you're much closer to this physically, I guess, than I am, to the CalPERS story. I believe it was predominantly CalPERS, and the issue over charging for the life-saving drugs. What's happened to that? Has that kind of died down, or is that still a...
Yeah, actually, that was more towards the Norway Sovereign Wealth Fund. So basically, there was a big story about the EpiPens and the makers of that. And there are other sort of drugs that... another one was a drug that helps with heroin overdoses, Narcan, and the maker of that. And it was a story basically... it's a bit old, but it kind of died down in the press. But it was a story about how that technology was licensed to a company, and that company was being backed by Norway Sovereign Wealth Fund. But I mean, Norway's Wealth Fund's kind of an index investor, so they're going to have exposure to it. But it's interesting how Norway was able to cut out coal, cut out child labor, cut out munitions, but then you have a company that's pretty much gouging people that really need access to these types of drugs. Because I mean, if you don't have access to an EpiPen or a heroin overdose drug, you'll probably die if you are allergic or if you have a drug overdose. So where does morality start? Where does it begin? And where is you as an institutional investor make that choice? And what we've seen, and just to tell it like it is here on the Follow the Money show, is that morality begins when there's enough people complaining about it. Yes, I mean, backing a company that is gouging the prices of drugs, that's pretty, in my opinion, that could be questionably wrong. But there's many ways to look at it, right? From a market standpoint. But at the same time, if you're going to take a tough stance on coal and on other things, why don't you take a tough stance on that? It's a very slippery slope, right? I mean, we see the story with the Dakota Access Pipeline. Two Norwegian savings funds, one of them was KLP, I can't really pronounce it because it's a very long Norwegian name, is basically...
KLP's fine.
Yeah, KLP's fine for now, but they're basically backing out of the funds associated with the Dakota Access Pipeline. And to give some context to that story, it's basically a pipeline that runs through, or it's adjacent to, some ground with Native Americans. It's a very passionate subject in the United States, going both ways. One way is to produce jobs and energy to connect the pipelines, and the other one is more of a protect the water and more of an environmental standpoint. But there's pipelines everywhere. If these wealth funds or these pensions or life insurance companies are going to be holier than thou and protest that, well, then there should be other pipelines that they should be protesting. There's pipelines in Nigeria. There's pipelines in Indonesia that's going over environmental land that could leak too, right? So it's really the power of the press and bringing issues to the forefront, and that's what gets institutional investors started and everything.
Yeah, it's that reputational side as well, isn't it? I'm sure there are many things that don't get talked about that are just as bad.
Thank you for joining Follow the Money. We have to cut this podcast a little short, but you can view us off Asset TV on the Asset Owner channel or on iTunes. But thank you for joining our show, and we look forward to catching us next time on Follow the Money.